Hello and welcome to episode 406 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. We're here again.
We are, and it's been a lot of fun this week because last week I spoke on the podcast. I said I'm going to put a question out on the Sunday and into Monday asking you what you do as listeners while you're listening to the podcast. And I think this should almost be a regular thing. If you ever feel like telling us what you do normally or what you're doing when you listen to the podcast, please do, because a whole load of you got in touch. And some of the things that people say they do while listening to the podcast, we had normally cleaning or commuting, walking the dog, mowing the lawn. My skincare routine was another one, eating a too good to go breakfast, on the treadmill, not one for listening to music whilst running, but MTTM hits different. Some more housework, walking to the shop to get the newspaper, and a slightly, hopefully, tongue-in-cheek one that says sleeping with a wink. So it's great to get all that feedback. What do you do while you're listening to the Money to the Masses podcast? Do let us know and we will read them out.
And talking of feedback, I wanted to give a shout out to one of our listeners who got in touch to give us, well, quite frankly, an amazing podcast review. And I would like to read it out now. So Jude got in touch to say, guys, I've listened to your podcast for years now and it's helped me out no end. I've financially navigated through divorce, a change in career, house ownership and my pensions with big thanks to yourselves. I listen to your podcast when out having a jog. I then replay the podcast to younger police officers in work when we were in the car on patrol, and I try and choose appropriate financial segments to their situation. Recently persuading one officer not to pull out of his police pension, but to budget better instead. I hope in 20 years he'll be grateful for making him listen to your pension podcast at 3 a.m. when out on patrol. I love sharing your advice and knowledge, so thanks. That's pretty cool, right?
That is one of the best ones we've had in a very long time. So thank you, Jude, for sending that in. If you go on our Instagram feed, you can read that full review actually. And then Jude also gives some further information and a comment as well on there. So it's great to read if you want to engage even more with that. And I also love the idea of all the jobs that people do who listen to this podcast. If we could ever meet them all, and so you said there, we've got police officers, the other people that we've met in our podcast meetups have a whole range of jobs and life experiences, which I find fascinating. So if you want to tell us what you do for a living or anything, then please do get in touch, because it does add a kind of colour and background to the audience that we're talking to. Because don't forget, Andy and I stood in a room on our own doing this.
Yeah, we should play occupation bingo. We've got a mug wall of fame. We could do something with occupations and tick them off. I want a taxi driver to get in touch next week. Right. So we've heard from the listeners and what they've been up to this week. So what have you been up to this week?
To be honest with you, Andy, not much other than sitting in the dark, because I've been taking part in the demand flexibility service. So that campaign to get you to use less electricity, which I've signed up to via my utility provider, and there's been 3 occasions where we've done it. So they encourage you to use less electricity for an hour on a specified date. I've done it and the results are quite interesting, because on one occasion we saved a couple of pounds, on another occasion we saved more and they doubled it. So I reckon in the 2 to 3 times we've done it, I reckon we've saved over £10. So that's £10 we've got back off our bill for the month. So they will continue to do it. So it does start to add up after a while. Right. So what's on the show this week? Well, we've got 3 pieces, and actually I think they're going to be pretty meaty, each of them. And so we're going to have to make sure we get through them at a decent pace. So the first one I'm going to do is regarding mobile phone and broadband price increases. Now, there have been a wave of announcements about the increases in prices on mobile phones and broadband. And if you follow me on Twitter, you will have seen me ranting about this. So I'm going to explain what it is and what you can do as a consumer, because there are, well, almost across the board, double-digit increases on their way. I'm going to do a piece that's related to investing, but it doesn't matter if you don't invest. This is about the important economic indicators that you hear about on the news or you might read about in the newspaper. And I want to talk about them and in relation to investing as well, because there are some of them you might not be that familiar with, which at the moment are moving markets when they're published. And the last piece is going to be a piece on cash in your ISAs and SIPs. I'm talking about stocks and shares ISA here and your self-invested personal pension. There's been some news. We'll talk about it in that section with Andy, because Andy's done the research, but there's quite a range of interest rates you're paid, and some don't pay you anything within the stocks and shares ISA if you hold cash. So we're going to be talking about that and the research that Andy has carried out.
Okay, so let's start with one of those meteor pieces that you mentioned. So broadband and mobile, double-digit increases across the board. You've got loads of research that I know you've been doing this morning, crunching the numbers on this, and some of it's crazy.
Yeah, so this week I received an email from my mobile phone provider telling me that the contract would go up by CPI plus 3.9%. So the price of my bill would go up by that amount. Now, obviously, I know what CPI is, and I worked that out very quickly to be 14.4%. So the price of my mobile phone contract was about to go up in the spring by 14.4%. But the email itself didn't tell me that fact. It told me CPI plus 3.9%. It was something that could have just passed most people by. But that's an eye-watering increase because it's a double-digit increase. But this led me then to go onto Twitter and start to rant. And you can go on there and find the tweet, and I hope everybody does, and they start to like and share the tweet, because the more people that do, the more chance that we can have an end to some of these rip-off increases in contracts. So as it stands, mobile companies, and it's the same for broadband as well, which I'll come on to, they can increase the price of your contract mid-term, and you can't do anything about it, so you can't cancel, as long as they state in the terms and conditions of the contract that it's there. So what that increase is going to be. So most of them have this increase of CPI plus 3.9%, or some of them have it with RPI. So there's similar sized increases, and it's almost across the board. Now, the reason I got obviously upset was not just because of the increase, because that's ridiculous, but it also means that we are seeing companies now that are using CPI in a world, or inflation-based figures, indexes, in a world where we've got double-digit inflation. Now, I get that companies have to pass on increases in costs, but what we're getting here is there's no relevance or relation with that increase, because they use the CPI or the RPI index as the basis with their own costs. This is an index that measures the increase in prices broadly for a basket of goods that consumers may buy. That is what the CPI index, we've done it on the podcast before. So if you think about it, what they're really doing is increasing the price of their products because other goods and services in the economy have increased. It's a bit like me running a garage and deciding to put up the price of a service or a tyre just because the baker down the road has put up the cost of something they do. Because they're baking in this index, this CPI increase, which I think is completely unjustified. Now, if the government is really serious about inflation, which they say they are, about bringing it down, and we did a podcast on that recently about inflation and the truth about it, the issue is if you've got products and services that we all use, broadband, mobile phones, where they're going to increase based on the increase in the official inflation figure, you've got basically a doom loop of inflation, because as inflation goes up, like we have now, high inflation that's above 10%, then we're going to get even greater increases on utilities that we use like mobile phone and broadband, which is ridiculous because that starts to create this vicious circle. So my tweet was me saying and ranting about the fact that we need to stop that happening. We need to stop companies putting mid-contract increases in there. Now, go and find the tweet, like it, share it. One thing I'll come on to is that Ofcom are looking into this. But let me go back a step now. So what happens is if you've got a mobile phone contract and you are still in that contract, so it could be 12 months, 24 months, then if a mobile phone company increases your price during that point, you are able to leave it without charge if it's not mentioned in the contract. The problem is that when they stipulate increases in their terms and conditions like RPI plus 3.9%, you can't really do much about that because you've agreed to that at the outset. Now, we're going to ignore the fact that there are some companies that might allow you to change tariffs to a cheaper one, but broadly speaking, there's not much you can do unless you want to pay a fee to terminate the contract. So you are really stuck as a consumer. Now, I went through and rounded up all the increases that have been announced for 2023. Now, there's a table, an article that we'll link to in the show notes, but broadly speaking, the increase, the mid-contract annual price rise for mobile phones is CPI plus 3.9%. So that's the case with BT, it's the case with EE, and it's the case with PlusNet, Talk Mobile, 3, But there are some others that actually use RPI, which is even higher. So that's Virgin Mobile. They use RPI plus 3.9%, as does O2. So there are nuances within those price increases, because there are occasions where if, for example, you joined or upgraded before or after a certain date, you might have slightly different increases. But I'm talking more generally here. You can find the nuances in the table. It will make a rubbish podcast if I read them all out. But it means for the likes of those that have RPI plus 3.9% increases, you're paying an increase of 17.3% on your mobile phone bill. If it's a CPI plus 3.9%, then you are looking at something like 14 or 14.4%. The reason it can be different is because it depends on which CPI number they use, because don't forget CPI and RPI is announced each month, so it depends which one they pick. So the actual increase, you need to look at the table or the terms and conditions of your contract. So there are some companies out there that don't increase, and that Sky is one of those. They have a promise not to increase during your contract, and Tesco did. Now, I say did because unfortunately this is quite timely. The news this week is they've decided to change their contracts for new customers going forward. What it ultimately means is that in the future, certain customers will have mid-contract increases unless they have a club card tariff with them. So that is one of the options that's kind of gone if you wanted to guarantee you weren't going to get a mid-contract increase. Now, when I talk about this, if you are at the end of your contract, then there are increases almost across the board. They're going to be the same increases that you'll get if you're a mid-contract customer where it was agreed in your contract in the T's and C's, but you are free to leave because you're no longer in a contract and you don't have to pay a fee because you're out of contract. So I'm focused on the mid-contract increases. So it means it also impacts SIM-only deals. So if you've got a SIM-only deal that might be on a rolling period, say 30 days, the increases will impact you. But again, you've only got 30 days to give notice and you can get out of it. So in a way, it doesn't really impact you because you can move around and shop around. Because the issue we've got here, and what I'm moaning about, is those people who are in a contract, they really can't shop around without having to pay a penalty. Now, one thing to point out, social tariffs aren't generally affected by any of this. So what do we do? The message on this part of the podcast is check the T's and C's of your contract to see what you've signed up to. Going forward, make sure you know what you're signing up to and what the increases will be. Now, the increases before, when it was CPI or RPI, most people wouldn't have paid much attention because obviously inflation is targeted to be down towards 2%. But now we've got double-digit inflation, it does have an impact. And of course, inflation is a measure of price increases. So yes, inflation will probably drop later in the year as people are predicting. But even if it does, we're now at the point where you're going to have a much higher mobile phone bill. So even a small increase on that, the compounding effect still takes place. Your bills are still going up. You're getting a smaller increase on a previously big increase. So it is a problem. Now, Ofcom are looking into this and they've launched an investigation. I don't know quite why it needs an investigation. It's going to take until later in the year. But I'm worried that when they get there, maybe if inflation has eased, then the urgency to make a change to the industry has been removed. So we need to have this ability to increase contracts mid-term with no seeming reference to the business's own underlying costs. We need that removed sooner rather than later. So you've checked your T's and C's, you'll see what increases that you are going to be exposed to if your contract even has them in it. One thing to bear in mind, because across the board these increases are applied to mid-contracts now, then it's very difficult to find somebody that doesn't apply them. So if you are out of contract and you get this email, like technically I am on the email that I got, I can leave, I can shop around. And if you're going to do that, use someone like Money Supermarket, cable.co.uk or Uswitch. As I mentioned earlier, if you're on a 30-day SIM-only contract, then you can leave after short notice. If you really aren't happy about having a tariff that goes up, you technically could go on pay as you go, but obviously that's going to be more expensive. You could, if you decide to leave, look for companies that aren't hiking. Now, as I mentioned, if you get a new deal with Tesco after the 27th of March, in fact, 2023, you will end up with a mid-contract price hike in the future if you don't have a club card tariff. But there are other companies that don't increase them. For example, I mentioned Sky and giffgaff have actually frozen the cost of their tariff until the 31st of December 2023. So there are options out there. If you are shopping around, do listen to podcast 402. And I'm going to put a link in the show notes to that podcast and the article it referenced, which was regarding EU roaming charges. Because if you're going to change contract, contract, then you may as well look to see which providers aren't going to charge you to use your phone abroad if you're lucky enough to go on holiday this year. And if you are in contract, then you can't leave, as I've mentioned, if the hike's in the T's and C's. If it's not, then you can leave within 30 days of being notified, because the provider has to give you 30 days notice of a price hike. And if they do, make sure you act quickly and you leave within 30 days of that notice, so you don't have to pay a penalty for exiting it. Now, in the show notes of this article, I'm going to link to Broadband, because it is pretty much the same thing. So you've got increases that happen on broadband tariffs, and the same rules apply about when you can get out of the contract after a price hike has been announced without penalty, and when you can't, and what your options are. Now, looking at the price hikes across the board, they are pretty much 14.4%, almost universal. There are some nuances in that. Again, I'm going to give a link to the show notes. So your bills are going up. And I know it's depressing to hear after I did the energy piece the other week, but you do have to budget for this. There are a few providers that you can cancel for free if the price goes up, because they don't have the mid-contract price hikes in the T's and C's, and they are Virgin Media, Sky, and now Broadband. And a final thing just to mention before I move on, a nod to Richard, who emailed in. He had an issue with his broadband, was unhappy about it and went elsewhere. But one thing to point out that he mentioned is that to contact the company first, because there's a very good chance you might get a price reduction and they might try to give you an offer to keep you. Yes, you'll be on a new contract. And you can even do this thing via the electronic chat functions on the website, so you don't have to be in a long queue. But it is a way to be able to get your mobile or broadband cheaper if you speak to them first, rather than just go away and sign up with somebody else. So it's one option to think about.
Just to finish this piece off, Damien, you mentioned social contracts. That's both broadband and mobile contracts. They are tariffs available for certain people who qualify for certain benefits. So it could well be that you qualify for one of those contracts, and this might spur you to go and look at what social broadband is, look at what social mobile tariffs are, and investigate that further.
Yeah, we'll put a link again in the show notes. And it doesn't mean just because they are social tariffs that they're worse products. It's about the cost of them. So moving on, Andy, get on to the next piece I want to do. So this is about economic indicators. So I was looking at investments and looking at my portfolio that I run on 80/20 Investor, and looking at market reactions in recent weeks to events that have been unfolding economically. And it dawned on me that I talk about certain things to 80/20 Investor members in the weekly newsletter. And I realised one of those things was about a particular economic indicator that really shook the market. And in doing that, I had to explain what it was. And then I thought, well, I've never done this on the podcast. I've never explained about some of the key indicators out there, maybe to keep an eye on, that could move markets. So even if you're not into investing, don't worry. It's something that you could find useful to understand what you're hearing maybe on the news or reading in the newspapers. Some of them are a little bit more nuanced, but I also want to give people a way of finding out when these announcements are coming that could potentially move markets. And maybe people are into investing in a slightly more short term, maybe trading, or just that people are more interested in what's going on with their long-term investments. So kicking off with economic indicators. Now, these are macroeconomic indicators, and they are useful from what you would call a fundamental perspective. So fundamental analysis is different to technical analysis. I've talked about technical analysis on the podcast, where I talk about things like moving averages, charts, drawing lines on them, all those kind of things. This is more about economic data that can inform you about the intrinsic value of maybe a company's share price or a particular investment. So there are two different types broadly of economic indicators, and they're lagging indicators and leading indicators. A lagging indicator is an economic statistic that tends to be delayed in its reaction to a change in that economic cycle. So when we're moving from growth to slowing to recession, that whole cycle over time, then a lagging indicator will tend to react in a delayed way to that. On the flip side, you get leading indicators, and they tend to predict the future changes in the economic cycle. So they can be very useful in determining the sort of intrinsic value of investments. And by that can mean that you'll get share prices suddenly plummet or rally because people think something is either undervalued or overvalued based on a piece of information that they've just got that's been released. Now, it'll make more sense when I go through some of them. I want to start with lagging indicators to give you an idea. Now, the Consumer Price Index is the main inflation index that we talk about. And I've talked about it already in this podcast, in fact. And in the UK, it's currently 10.1%, which is obviously very high. And it's a measure of the increase in prices that us as consumers experience. It's calculated by the Office of National Statistics. And what they do, they get an imaginary basket of goods and services, and they use that and analyze the increase in prices over time to be able to give an indication of inflation, and that's CPI. And there are other measures. There's RPI, which I also mentioned in this podcast, which is calculated slightly differently. Now, CPI inflation data is pivotal at the moment, and it's crucial because it informs central banks' policy. And I'm talking about monetary policy, in particular interest rate rises or cuts. So I've talked about the analogy in the past, like driving a car, where we have inflation is the rev counter. In order to keep those revs under control, you move the gear stick up and down. So you move it up, so move up the gears, you increase interest rates to bring inflation down and keep the car moving forward, which is economic growth. If inflation starts to fall, then you move down the gears, cut interest rates is the analogy, and then you'd hopefully stimulate economic growth. So the reason inflation is important because it can influence interest rates, which have a huge impact in the economic cycle, and also as a consumer because it impacts things like savings rates and mortgage rates. So that's a lagging indicator. Whenever those information points are published, which is monthly, that can have a big impact on the market. In particular, notice the US Federal Reserve, when it publishes its inflation data, because of the size of the economy, it's the biggest economy in the world, it has the biggest impact on investment markets. So if you want a date for your diary to look at some crazy stuff that's going to happen potentially in markets, then that's one of those days. And I've drawn charts in recent weeks for 80/20 investor members, which has highlighted the release date of inflation data in the US. And you can see the markets have turned direction based on whether inflation came in hotter than expected or it was slightly lower than analysts expect. Moving on, GDP, so that's gross domestic product. That's the monetary value of all goods and services produced in an economy. Now, this is usually released quarterly and then can be revised. So we talk about GDP and importantly recessions at the moment. So if you get 2 quarters of negative growth, that's the technical definition of a recession that people widely accept. And we narrowly missed that at the end of 2022. So we're not in a recession technically, but it can very much feel like we are. This is lagging because it reports on what's already occurred and then it gets revised as we get more information at a later date. So we could find that we technically end up in a recession. So we ended up in a recession at the end of 2022 when we get more data in a couple of months' time and they revise the figures for that last part of 2022. So don't be surprised if you see a headline that mentions that. Now, the other thing to note that information is quite relevant when it's released. So we get that every month. It's domestically relevant for maybe smaller companies. So if you see GDP numbers about to come out, keep an eye on not necessarily the FTSE 100, go further down, the FTSE 250, down into even smaller caps below that. So if you look at the FTSE All Share that covers everything in UK equities, then you'll probably see a bit more of a violent reaction if it comes in at an unexpected rate. We do get monthly estimates from the ONS on inflation data as well. So that's something to bear in mind. Another lagging indicator are job market statistics. So each month we get reports about the unemployment rate and wage growth. Again, they are lagging, but what they do is they also give insight into what might happen to inflation, because if wages start going up over a period of time, then that could mean that more money's out there chasing the same amount of stuff. That starts to push prices up. So that's why if you listen to TV, radio, when the Bank of England talks about inflation, they often mention wage growth because they're worried about it, because you can get into a spiral of further inflation. And it's also one of the excuses that the government uses to not raise public sector pay. If we see unemployment figures change, so if they weaken or they strengthen, that gives you a potential view on what's happening to the economy. So if unemployment goes up, it could be a sign the economy is weakening. In the US, they have something called the ADP jobs data. So it's a software and services provider called Automatic Data Processing that produces some employment numbers. And there's also the Department of Labour's monthly non-farm payrolls reports. When they're released, they have quite a big impact on markets because of that indication of how strong or weak the economy is. Because if the numbers come in and there's more jobs added to the economy than was expected, significantly more, for example, then it could mean that people think, well, the economy is holding up. That gives the US Federal Reserve more scope to raise interest rates to combat inflation, because obviously when you raise interest rates, you can dampen economic growth. So it means that can cause asset prices to change, stock prices to change, as people reprice in their bets or their predictions of where rates might go in the future. And another one that's a lagging indicator is commodity prices. So especially oil, because oil is a good indicator of economic growth because it's used in so many things, not just in the production of things, but also the transport of things. And if you see when you get this China opening narrative, the reopening after COVID, then you'll see the oil price start to creep up if people are betting that we're going to get a big wave of economic growth. Now, I want to go on to leading indicators because this all comes to almost leading to the one I really wanted to talk about, which is the producer price index. Now, this is a measure of the changes in price of goods bought and sold by manufacturers, including the materials and fuels purchased. So you think about input prices, and it's also a measure of what they call factory gate prices, so it's output prices. And another way of thinking of it is it's an inflationary measure that's experienced by the manufacturers, the producers out there. And as such, it can be a leading indicator of where CPI is going. So the inflation that we all think about, the CPI measure, because if the prices are going up that are being experienced in the manufacturing or production stage, then that's likely to feed through to us as consumers. And in the US, we had a PPI number come in that was much higher than had been expected. Just days before, we'd had a CPI number come in broadly in line with expectations, but because the PPI one came in a few days later that was much higher than people thought, they suddenly panicked over whether we're going to suddenly see a spike in CPI at a later date, i.e. inflation was going to come back. It wasn't going to keep falling. And so that caused the current sell-off, basically, that we're seeing in equity markets at the moment. It's been rolling for a few days. Now, another index is the Purchasing Managers Index. You'll hear them talk about in the news. They'll talk about PMI. And that is an indicator that gives the rate of expansion or contraction of particular sectors within an economy. It has a base value of 50. So if you hear them talk about 51, that means it's increasing. The higher that number, the greater the reflection of that increase. And also you can get below 50. So if it's 49, 48, that's a reflection of the contraction. So that gives a leading indication of how sectors are doing. And don't forget that the services sector in the UK accounts for 79% of UK economic output. So that's the one they all focus on. When you hear them talk about PMI, they talk about services PMI. And it's not just in the UK, it's much more widely. So you sometimes see those PMI numbers get released for all around the world and you start seeing markets move. Another leading indicator, I mean, I see different views on this, but house prices is one of them because people's wealth is tied up in house prices. How they behave can be an indication of perhaps where we are on the economic cycle or where we will be. So one potential index is the Halifax House Price Index, which is calculated from its own database of mortgage approvals. Now we have an article where we look at all these indices for house prices each month and what they might be telling us. Moving on from there, retail sales. So the ONS, the Office of National Statistics, they're a busy bunch. They release a monthly report on retail sales activity. This gives us an insight into the demand and spending patterns of consumers in the UK. So that again could give an indication of where we are in that economic cycle. I don't often see big movements when I look at markets around the retail sales numbers, but when it's added to other bits of data that we get, some of the others I've mentioned, it can build a case for maybe there's starting to be a shift in behaviour. So they're worth keeping an eye out for still. And then you've got the consumer confidence Index in the UK. So GfK do this, and it's basically a survey that looks at consumer confidence. There's various different factors in it, and if it has a reading above 0, that's a positive view from consumers. If it's below 0, it's obviously a negative view for consumers. But of course, that's important, because if we feel positive about the future, then we're much more likely to go out and spend money, and that's good for the economy, etc., etc. Now, if you find that interesting, it is definitely worth you doing a bit of homework where you just look at what happens in markets. I'm talking about stock markets in particular, but you can also look at bond markets. If you go to tradingeconomics.com/calendar, there is a tool where you can look at all the economic data, the big releases that are coming out across the world. It is literally everything. But jump in there, you can do a filter, and you can actually put the most important as a star rating, put it on 3 stars. That will give you the ones that tend to have a big impact on markets. And you can also do it by country, and I often focus on the Euro area, the UK and the US, because they're the real biggies. So if you find that useful, go and look at it, and then have a watch what happens on your stock market app when you look at your different indices, when you get certain pieces of data. At the moment, the real big ones are related to inflation data.
Okay, let's move on to the final piece then. And we're going to be talking about investment platforms and how they deal with customers that hold cash within their portfolios.
Yeah, so this came about because I've spoken to people in the past who seem frustrated at the fact that, well, how much do I get paid when I sit in cash within a platform? So we're talking about stocks and shares, ISA, maybe a SIP. So we're not talking about cash ISAs, because you can have a cash ISA that can pay you decent money. You can have fixed term product that can boost the interest rate, and of course you can transfer from a cash ISA into a stocks and shares ISA. What we're talking about here is when you're with an investment platform that may be running your pension on, maybe it be Hargreaves Lansdown, Fidelity, it could be AJ Bell, or even Vanguard. What do you get in terms of cash return on your SIP and your stocks and shares ISA? Because it is different, because there are times where you might hold cash temporarily. I mean, the idea is not that you'd be holding cash long term on these platforms, but you could be holding it temporarily. Do you get anything? And it was interesting because this week Hargreaves Lansdown was criticised for the amount of money. They made over £100 million. It was more than 50% of their profits, in fact, in the last 6 months of 2022 from the differential between what they paid customers for cash, so the interest rate they gave to customers, and the rate that they get themselves. So if you looked at it crudely, it's really the difference that they were keeping, and it increased their profit line. Now, Hargreaves aren't unique in this. There are other platforms out there, including some of the newer propositions out there that might just do ETFs, for example, that are low cost or free. But they do also make money on the differential between what they pay customers for money that's sitting in cash and between what they receive from the bank or institution that where the money is. So that's something to bear in mind. So Andy crunched the numbers. He went and looked at it. It took him ages, in fact, and he's built, I'm looking at them, Andy. They are beautiful. They're beautiful heat maps, which I don't know why I'm laughing. I think it's because I'm using the word beautiful in a money podcast. Yeah. But he's built the heat maps that visually show you where the best rates are. Now, the point of this, before I let Andy loose with his stats, is not that people would go and pick a platform just because of the cash rate that's there, but it's one of those things that's a soft fact that you might tick a box as a reason why you might like that platform alongside other things, because there are going to be times maybe where you might be sitting in cash. And it's a bit like what we had with the first piece I did on Broadband and stuff, where the T's and C's of the particular product were really built in a time that was prior to what we are now. So in this case, in the last decade or more, you never got anything on cash. So you didn't really care what you would get on your stocks and shares ISA or your SIP, because the return on cash was awful. A bit like mobile phone bills, where inflation was so low that if they baked in the CPI increase, you probably didn't really care, to be quite frank, because everything else was going up at the similar rate. But now the world has changed. With inflation high, which has led to interest rates increasing, now people are sitting there looking at that going, well, I can get over 3% on an easy access rate in a ordinary bank account. People are looking at that and thinking, well, I want something on the money held within my investment portfolio. So Andy, that was quite a big intro for me. So I'm going to hand over to you.
Okay, well, the first thing to mention is that these rates that I'm going to read out are going to change frequently. Obviously, interest rates are going up. And so, as a consequence, nearly every investment platform will put heavy caveats on the rates that they're offering. And it will say these rates are subject to change at any time. So, picking out some of the highlights then, the rates that you get on ISAs compared to the rates you get on SIPs are actually not often the same. In fact, most investment platforms will pay slightly more for money held in a SIP. Let's look at ISAs first of all then. I've covered the major platforms in the UK. I'll quickly read off the list of them. There are 8. There's AJ Bell, Best Invest, Charles Stanley Direct, Fidelity, Hargreaves Lansdown, Interactive Investor, iWeb, and Vanguard. Well, first of all, if you're going into an ISA, you probably want to steer clear of iWeb because they don't pay anything in terms of interest held on cash in an ISA. And then you've got a whole bunch of investment platforms that pay anywhere between 1.5 and 2 to 2.5% for anywhere between 0 and over £100,000 held. Now, most investment platforms do a sliding scale, so it will depend how much you hold with them to how much you'll get. Interestingly, Fidelity don't. They actually pay a flat rate right the way across. So actually, they're quite competitive. They'll pay 1.5% on very low amounts of cash, but it's the same 1.5% right up until however much you hold. We're well over £100,000. So they're actually less competitive the more you hold. Let's quickly highlight the best one out there. I'm going to mention them. Best Invest, they're going to pay 3.1%. Now, Damien mentioned that the best easy access savings rates at the moment are nigh on sort of 3, just north of 3%. Well, you're going to get that with Best Invest. Again, these rates could change, but right now, no matter what you hold with Best Invest, they're going to pay over 3%. In fact, it's 3.1% as of the 27th of February.
It is interesting though, Andy, you mentioned iWeb there. They are a platform that don't charge a annual fee, a platform fee, yet they don't pay anything on interest. So make of that what you will. Moving on to SIPs then, is it not just the same as a stocks and shares ISA?
No, it is quite different actually. You mentioned iWeb, so let's highlight them straight away. You pay nothing on ISAs. Again, they are a free platform, save for the £100 setup fee if you're a new customer. On a SIP with iWeb, they pay a fairly punchy 2.5% right across the board, no matter how much cash you hold with them. But of course, they do charge fees for SIPs. So perhaps, again, that might be a reason why you actually get something back in terms of interest on your cash. I spoke about Fidelity in the ISA. It's a flat fee of 1.5% for their ISA. Bit more for their SIP. They're going to pay 1.9% flat rate right across the board, no matter how much you hold with them. Interactive Investor, we haven't mentioned them yet. They pay a decent rate of 2.5% so long as you hold more than 10,000. It's only 1.5% for anything less than 10,000. Again, Best Invest, I've got to highlight them again. For SIPs, it's that same 3.1%. So it's really simple with Best Invest. If you're going to hold a lot of cash, ISAs, SIPs, you're going to get a decent rate that's almost equivalent to the current best easy access savings rate.
So if we had to give a broad average, then it does depend on the platform and amount you have in your portfolio. But on the stocks and shares ISA, it's about 1.6% is an average, and on a SIP, it's 2.2%. That gives you a benchmark. If you get anything above that, then you're getting better than the sort of market average. Below that, then you're not. Vanguard, I'll just mention that. I know there are a lot of Vanguard investors out there. They pay 2.2% across the board on everything from March the 13th. Now, what is interesting about Vanguard, and it's just a bit of a story to give a backdrop of why we also started looking at this, because no one else has sat there and done the research, because it's very long, convoluted. And there was a thread that was online that I discovered a couple of weeks ago where somebody highlighted that Vanguard were paying a much higher rate than that 2.2%. In fact, at the point that the person made the observation, they would have beaten the best easy access rates that were out there. And what happened, it seems, this thread went viral, and a lot of investors who were putting it on forums suggesting you could just go on Vanguard, secure your ISA allowance, and just leave it in cash. Even you'd be getting what you would do on an easy access savings account, and it would be in an ISA. And then very quickly after that, Vanguard moved to cut the rate, to slash it down to that 2.2%. Now, I can't say one led to the other, but they're 2 points in time that were very close. And obviously, you've got to think that as an investment platform, traditionally, they've not wanted you just sitting in cash, although it does seem now there are a number of platforms that are making a decent return on you sitting in cash. So this is also interesting because, as I mentioned there, if you want to secure your stocks and shares ISA allowance for the coming year, you're not going to go into a cash ISA, then you can just put money into an ISA and not have to choose your investments. It's how you can just secure your allowance. You can pick your investments at a later date. The research might make you think if you haven't got a platform already.
And just to finish off this piece, I just wanted to mention that literally in the last 24 hours, an email hit my inbox from Moneybox. I'm sure people have heard of Moneybox and who they are and what they do. They're just about to start paying money on cash held in their stocks and shares ISA. This is something they haven't done before. And so new customers can get that straight away by downloading the app. Existing customers will need to re-download the app to gain access to it. But the rate that they're offering is pretty punchy. It's 3.25%.
Great. That is it for this week, Andy. We've done a lot of research, actually, that packed into that show. So if you want to review our podcast, please do, because we do appreciate it. Please also leave comments online. Don't forget that tweet I mentioned. Go and share that as well if you're not happy with the state of play with the way broadband and mobile phone bills are priced. Also, let us know what you do for a job and what you're doing in terms of listening to this podcast. Where are you? What are you doing? And who's to say we won't be sending out some Money to the Masses mugs? We love the community that is being built around Money to the Masses. So make sure you go to facebook.com/groups/Money to the Masses, where you can join our Money to the Masses group, where you can have conversations and ask questions in there. And mentioning questions, in the coming weeks, we are doing a remortgage special, where we're going to be posing questions to a mortgage broker and sending your questions. They're going to be anonymous. Anything that you might want to ask about remortgaging and we're too afraid to ask, send them in. You can send them to andy@moneytothemasses.com, damien@moneytothemasses.com, or send them via socials, and we'll collate them and we'll make sure we ask them and publish them on the show.
Right, that's it. Until next time.